Today you've joined the webinar for the Pengana High Conviction Property Securities Fund with Amy Pham. My name is Melissa Raylander and I'm the Business Development Manager for Pengana in Queensland. Today, Amy is going to take us through a backdrop on REITs and provide an update on the fund, which has just ticked over a 5-year track record, and share where she sees opportunities. You can ask questions. There is a little question box at the bottom of your screen, so please pop any questions in there. And then at the end of the webinar, we will endeavour to get to as many of those as we can. With that, I'm going to hand over to you, Amy.
Welcome, everyone. I'm going to start by introducing the team to you. So over to the team slide, please. So there's 3 of us, myself, Jade Ong, and Sam Craig. Jade and I have been together since the inception of the fund, and Sam joined us about 3 years ago. It's very, very flat structure. It's a small team, and together we've got over 50 years of combined experience. Over to the next slide. So it's a stable team, same team delivering on the same strategy. So what have we achieved in the past 5 years since inception? We've delivered consistent strong returns of 8.1% per annum and outperforming the benchmark by 3.8%. And this is done by adopting a disciplined investment process whereby we focus on cash flow and also the balance sheet. Those are the 2 most critical factors that we look at when we analyze stocks. And what sets us apart here is that we do the work ourselves. We don't rely on consensus numbers. We've got all the financial models for every single stock in our universe, which is 52 stocks, and we do all of the groundwork ourselves. Similar to other funds at Pengana, my interest is aligned with investors, as I have both equity share in the business, and also I'm a co-investor in the business. Turning to the next slide. So looking at our track record, we have outperformed consistently over the 1 year, 2 years, 3 years, and since inception. Looking back, last year, it's been a very, very volatile year in the sector, and we've managed to have done really, really well. And this is because our process has always been focusing on, quality of assets, quality of management, free cash flow, and a strong balance sheet. And that has helped us to deliver this strong, consistent outperformance relative to the benchmark. Over to the next slide. So for those who not familiar with our strategy, we are a high conviction A-REIT fund, focusing on ESG and secular trend. Being high conviction means that we have a concentrated portfolio holding an average of about 15 stocks out of 52 stocks in our universe. We hold best of breed, and we invest outside of the index. Actually, the majority, like up to 40% of our investments are outside of the index, which provides you with further diversification. We incorporate ESG to manage risk, and we also prefer sectors that are driven by secular trends, such as data centers, such as hospitals, childcare, manufacturers' homes, estates. These sectors not only provide us with further diversification to the sector, but also because it's driven by secular trend, its earnings are a lot more sustainable. Next slide, please. So a lot of investors compare us to G-REITs, and despite the fact that G-REITs is provides you with a lot more stocks to invest in, if you look at over the past 5, 10, 15 years, A-REITs has actually outperformed G-REITs, and we think that this is because of 3 things. Firstly, the quality of A-REITs is a lot higher than G-REITs. A-REITs have delivered in the past 15 years a higher distribution yield at about averaging about 6% compared to G-REITs at about 4%. And also the average gearing of A-REITs is a lot lower than G-REITs at about 27% compared to G-REITs on average of about 40%. So yes, despite the fact that G-REITs offer you a much broader investment opportunities, it also comes with high risk of lower quality operational risk. And on top of that, you've also have to deal with currency risk and geopolitical risk. So turning to the next slide. So as you all know, there's a lot of volatility in the market, especially since Trump has announced his tariff. I think that the A-REIT has entered into this volatility and potentially much lower growth, global growth, in a really good position. If you look at the average gearing of the sector, it's sitting at about 27%, which is low. It's in the lowest it's ever been in the past 20 years. And with this, we think that not only that it's got a strong balance sheet going into a weaker global environment, but also in terms of valuation, it's at the bottom of the valuation cycle, particularly office assets, whereby it's already fallen more than 25% since the peak, which is 2 years ago. Going to the next slide. So, in the past 2 years, REITs have been quite, in low growth environment because of the high interest rate and also high inflationary environment. But going forward, we think that inflation's coming down, rates is expected to come down as well, and this will aid and support the earnings growth of the sector. And with this, we are forecasting an average earnings growth for the sector of a range between 3 and 5%. This is quite attractive because REITs are considered to be a defensive sector relative to general equities. And looking forward, we think that it's offering, a really attractive total return of close to 10%. So looking at an average earnings yield of about 5% and EPS growth of about 3 to 5%. We also think that transactions have picked up in the sector, and this not only tells us that going forward, this gives us more evidence into what the true valuation of particularly office sector, but also it gives us confidence that we are sitting at the bottom of the valuation cycle. So this is how we're positioned relative to the benchmark. As you can see there, we've got more than 20% exposed to the alternative sectors, such as manufactured housing, residential development, storage, service station, compared to the index of only 7%. Now, when we look at more matured markets such as in the US and the UK, alternative assets actually make up more than 50% of their benchmark. So we think that by us positioning ourselves as focusing on these alternative assets now, we give ourselves a much, ahead of the market in terms of where the capital is flowing into. And also on top of this, we think that these alternative assets tick all of our investment criteria. They've got, strong tenant covenants. They've got long leases, 10 to 15-year leases. And these assets have got very high barrier to entry, which at the end of the day protects the tangible asset values of these assets. So looking at our track record, and more importantly, you can see there we've outperformed not only the index, but also our peers on the 1 year, 2 years, 3 years, and since inception period. Looking at when we've done this with much lower risk than the benchmark and our peers. So the chart on the right-hand side there, it measures the risk in terms of the standard deviation. And you can see that in each of those periods where we have outperformed the benchmark and our peers, we've done this with much lower risk as well. So looking at what has worked and what hasn't really worked for us in the last year or so. So the residential names has really worked for us in delivering that outperformance, such as our investments in Mirvac, Ingenia, Stockland, and Aspen. We think that this is just the beginning. And there's further growth to come from these residential names, especially now when we're just starting on the start of a rate cut. Obviously, you would have known that the first rate cut was back in February. We think now with the volatility in the market, the risk of the US going into the recession, economists are now saying, factoring in another 3 rate cuts over the course of 25. So this will benefit a lot of these residential names. But even besides, even if we don't get the rate cuts that we anticipate, sales growth has really picked up since last year for a lot of these names. Mirvac and Stockland had their operational quarterly update yesterday, and pleasingly, Mirvac has come out. Both of them has reiterated their earnings guidance for the year, but also Mirvac has come out to say that their pre-sales has hit over $2 billion, which is the strongest it's ever been in the last 5 years, and this is giving us visibility and confidence that we're seeing a recovery in the resi market. The things that didn't work for us, the stock that didn't work for us included NextDC. Actually, NextDC were the top contributor for us last year, but beginning of this year, it had a bit of a downturn since DeepSeek came out in February. And then not long after that, we had Microsoft announcing that they were cutting back on their data center development capex. So the market sort of sentiment towards AI-related stocks were weakened, but we still think that longer term, the thematic is still there for data centers. In fact, if you look at the demand for data centers in the past, 5 years and even to today, 70% of demand for data centers still coming from cloud computing. And so, even if the demand for AI is not as aggressive as the market has anticipated, there's still very, very good growth of about 20% anticipated for cloud computing adoption. So we think that investments in data centers is still very, very safe, and long-term thematics is still there for data centers. Now, for Dexus and GPT, early in the year, the market rotated out of growth stocks and into defensive stocks, and these two stocks are, trading at quite a large discount to book value, and so we were underweight these two stocks, and it detracted from our performance. Looking at the next slide. Our philosophy has always been to protect capital, and if you look at since inception, our track record, we've done just this. So when the market is hot, we don't tend to shoot the lights out when the market is up, as you can see there by the chart on your right. But when the market is down, we tend to protect capital and have a much lower drawdown than the market. And this is because of our strategy to focus on quality of assets, strong balance sheet, and our valuations is always based on free cash flow. So this is a snapshot of where we're positioned and how we see the market, each of the subsectors going forward. As I mentioned earlier, we're still very positive on the thematic drivers of data centers. We are very positive on residential, especially the more affordable side of it, which is the house and land packages, and also the land lease model for retirees. The sectors that we think are under a bit of pressure at the moment, that includes the healthcare sector and also the childcare sector. And as you know, these two sectors have been under quite a bit of pressure in terms of the operating cost, which puts a lot of pressure on the operator. And so therefore, it growth in terms of these two sectors has been quite muted going forward. In terms of office, I get asked this all the time. When do I see a recovery in office? I think that valuation, I think we're there already. We're at the bottom of the valuation range for office. But operationally, I think it's still a little bit challenging. And that's because, vacancy rates, Sydney, we're looking at 15%. Melbourne, we're looking at 19%. Brisbane, we're looking at 12%. So vacancy rates is still quite high across the major cities in Australia. But the one thing that we look at, which is the free cash flow, and incentives for office is still very high, ranging from anywhere between the 30 to 40%. So free cash flow is quite poor when you look at it in that aspect. So we are still underweight office, but we're seeing some green shoots. Especially in the more sort of high premium quality office assets. And that's showing in the data right now, because the vacancy rate for the premium assets of Sydney is at 6% compared to the market of 15%. So I want to go through two stocks that we like, which is not in the index. The first one is Qualitas. They are a real estate private credit fund manager. Their FUM now sits at about 9 billion, and they're looking to double that by 2028. And we're confident that they're able to do this because they're running at a deployment rate of 4 billion a year per annum, and they've got dry powder of another 2 billion to deploy. And looking at their peers, they are trading at a very attractive PE of 19 times versus their peers of about 30 times. So we think it's relatively cheap and offering really, really good growth of about more than 25% per annum EPS growth. The other one that we like is Cedar Woods. We like Cedar Woods because when we look at what it's trading at in terms of PE, it's trading at 8 times PE, which is really, really cheap compared to its peers of about 18 times to 19 times. and delivering above average growth of more than 15% EPS growth. In actual fact, yesterday when they announced their quarterly operating updates, they actually had an earnings upgrade. So first, beginning of the year, they were forecasting EPS growth of 10%. They've now increased that to 15%. So we're very, very happy with our investment in Cedar Woods. We think that the fact that they're quite diversified in terms of not only geographically, but also in terms of their product range. So, they can tailor it more to suit the current market. So when things are challenging, they can turn on the more affordable product, which is the land and house product, and then when things starts to pick up, they can increase that to the sort of like the townhouses and the apartments product. So they've got a very good wide range of product, and we think that this stock is going to continue to do very well going forward. Now, I'm going to leave you with that, and I'm going to turn to Mel to see if there's any questions.
Hi, Amy. Thank you. Yes, there are a few questions that have come through, and I just have to say, I always love hearing your updates. Your passion for the sector definitely comes through. One of the first questions that we have had from our attendees is on one of the slides earlier, you showed the A REITs outperforming G REITs. To what extent would Goodman Group have driven A REIT performance, and would the outperformance have been more or less flat?
Yeah. Look, Goodman has done very well over the last 5 years or so, I have to say. And Goodman makes up about 37% of the benchmark. So yes, that Goodman has got has contributed a lot to that performance. But that chart shows you that it's over 5, 10, 15 years. And if you look at the 10 years and the 15 years, you look back, Goodman only has done really, really well in the past 5 years.
Yeah.
So really, the 10 and the 15 years, it's got to do with the attributes of the whole sector and not just Goodman.
Awesome. No, that's a great answer. Another question we have is, with so many A REITs trading at discounts to NTA, do you expect to see an increase in M&A activity in this space? For example, GPT and DXS merger.
Yeah. Look, I think that that whenever you have the REITs trading at large discounts to NTA, you will get a pickup in M&A activities. Already, we're seeing ASK being taken over right now, and so I think we're going to see more M&A activities happening, but in terms of Dexus and GPT merging, I find that a bit harder to make that work, because they're two very, very large vehicles, and I don't. GPT has already got quite a large exposure to office, and probably they don't want to double that.
Yeah.
And then on the reverse, Dexus has already got funds management business, which they've grown successfully very well in the last 2 years. So there's not much that GPT can offer. So for us, look, we don't invest based on M&A activity, because it's an unknown process. We just look at valuation and what the cash flow tells us.
Okay, cool. And that leads nicely into the next one of the next questions that came through in that the cash flow evaluations on next DC. What were some of the report return drivers that you saw with that, and why has the thesis changed?
For next GC.
Yes.
All right. Look, we we were quite overweight next DC. Actually, it was one of our top holdings in next DC last year. But it was trading at a quite a hefty valuation for us. It was up there in the, I think it was like 38 PE. So we did reduce that down. Um, and then since then, the DeepSeek thing came out, and then Microsoft announcing that they were cutting down on their capex on data centers. So, and then the market was questioning on the growth of AI. So it's now come back quite a lot, and it's now trading at about 26 times. So we think that it's starting to look attractive again for us.
Awesome. Um, I think I'm going to ask this question as a two-pronged question. So there's a lot of volatility in the markets. Are REITs broadly more attractive than equities, do you think, in terms of downside risk? And then I guess also your portfolio exhibited a lot of downside protection throughout time. So again, comparably, do you see your portfolio as maybe better placed than general REITs in terms of the volatility they're experiencing?
Yeah. Look, REITs is considered to be defensive relative to general equities because of the lease structure, and it's got very minimal exposure to operational risk. Um, so we think that in times of volatility like this, REITs should be supported and perform relatively well relative to equities. In terms of where we're positioned, being high conviction not only allows us to manage um, our positions in the large cap stocks such as Goodman, right? But also it allows us to invest outside of the benchmark. So it gives us much more sort of ability to a wider range of opportunities to pick stocks. So I'll give you an example. Last year was the volatility, the dispersion between the top performing stocks and the bottom performing stock was the widest I've seen. Over this 25 years of investing in the sector. So the top performing stock was Aspen at 70% return for the year
Wow.
versus the bottom performer was Lifestyle Communities at minus 50%. Right. Now, if you were a passive investor, you're getting the average of these two, right? But as a high conviction stock picker, right, we have this range to pick on. And so therefore, we're able to pick the best of breed out of this volatility.
Yeah. So you think in general the sector should perform well due to the cash flows, and your fund should again continue to perform even
That's
better.
right. That's
And I
right.
will note it has been top quartile, so obviously doing an excellent job, which I think that's what led you to create the fund, isn't it, Amy, to have a genuinely active mandate so that you had full flexibility in your investing.
Yes, yes, because I just think that, you know, uh, for the past 10 years, the sector has really been passively managed. And I really do think that there is, a place for active management, and there's a place for alpha to be generated in this
Well,
sector.
I think you have proven that so far. In terms, I guess you touched on Goodman. How do you go about managing the Goodman exposure is another question that's sort of come through.
Yeah, like as I said, a lot of people, investors have said to me, why would I invest in your stock when I can just buy Goodman on the share market? And they've been right, because Goodman has been a fantastic performer in the last few years. But going forward, I think that the view of Goodman being able to deliver this superior growth and dominance in the market, that that has dispersed. Um, and mainly because they're going, as you would have been aware, that they are, 50% of their development WIP is going to be to data center, and that changes the dynamics and the risk profile of Goodman. Whereas before it was just logistics, and the market understands logistics. The market knows that Goodman is a superior, and have got extremely good track record in managing and developing logistic assets. But data center is quite new for Goodman. And so, with this divergence in views in Goodman, it creates an opportunity for us as an active manager to manage that that position of Goodman.
Got it. No, copy. What will happen to REITs if we go through a period of stagflation?
Okay, so stagflation, for those who don't know, it's when you have low growth but high inflation, right? So I think that if we do go through a stage of stagflation, it just means that rates will not be cut as aggressively as the market anticipates, because of the high inflation environment. So with that, there's going to be higher for longer interest rate environment that REITs have been going through for the past 2 years, really, since COVID. So I think that the market will support REITs that has a strong balance sheet, and also have got third party access to capital, which means that they don't rely on further debt in order to fund the development. They can go to third party capital, or they don't have to go to the market to raise capital. So that they're able to grow their earnings without relying on gearing up their portfolio.
And then it makes sense that this question has come through because it's quite topical. Do you see the higher tariffs that we're seeing having an impact, I think particularly maybe on your portfolio and then broader REITs earnings?
Yeah, look, I think direct impact minimal, because REITs have got minimal exposure to global trade. The only flow on effect that I can see is the future demand for, say, logistic assets going forward. But sitting here today, most economists don't really know what's going to happen in terms of tariffs over the next few years. So I think that for now, we think that the flow on effect to growth, which is and inflation, is going to be the main concern for investors going forward.
And if you were to, this is a question for me, Amy, if you were going to design a portfolio, which I'm sure you have for yourself, what do you think is a sensible allocation to REITs, knowing, you've obviously been working in the sector for over 25 years, but have been exposed to equities across the board. So what makes sense from your perspective?
Yeah, look, I think that a lot of investors, a lot of investors overlook REITs. They tend to go passive in domestically, or they go to G REITs, or they say, "Oh, I'm just going to invest in general equities," and general equities have a proportion of that invested in A REITs anyway. Um, Look, we've just demonstrated that A REITs have outperformed G REITs. We've just demonstrated that that active has outperformed passive, right, with much lower risk, right? Um, I think that if you look at if you look at what is held in a general equities portfolio that is considered A-REITs, it's only, three names, right? It's either Goodman, Charter Hall, or GPT, really. So that's only three names. You're missing out on 52 names that the team and I have got access to and look at it every single day, right? And the way that we come up with our analysis is that, we do our own financial modeling ourselves, and we spend 60% of our time either meeting up with management of these stocks or out on the road looking at the assets.
And when you're, I guess, interviewing the managers and looking at the assets, how much does that meeting and trust in the manager play into your valuations? Obviously, it's not something you can quantify in a model, but how do you factor that in?
Well, look, everybody have access to all the financial data, right? But by investing with a fund manager like ourselves, we take that, and we have a much better understanding and insight into those numbers and the strategy that 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 the fund managers has. So therefore, it gives us more confidence that the assumptions that we make that goes into these financial models actually, um, is real and not just numbers that we just plug in, you know, out of consensus numbers. These are our numbers.
No, that makes a lot of sense. Well, we've had some great questions come through, so really appreciate it. I think one of the big highlights I got out of today is investing in REITs is a great way to get access to some of those alternatives and secular shifts. I'm not sure that there's in many other sectors that you can gain access to that demographic change that we're seeing. So you can see a lot of reasons to incorporate them in your portfolio. And obviously, you've done a sensational job of proving that active management works. If you do have any questions, please feel free to send them through to us. We really thank everyone for attending today and hope to talk to you soon.